Tax losses are one of the most valuable things in your financial life, or they can be. So I thought I'd explain them to you right now. Tax losses can be in a personal name, and I'll go through a couple of the key losses here in a personal name. The first one is if you have a rental property, it's in your own name, and the expenses are more than the revenue. So you're getting rent from the tenant into the property at this level of income, and all your interest on your loans and expenses such as rates, repairs and maintenance, agents' fees, etc. are above the revenue from the rent. So essentially, expenses more than revenue equals a loss. And the ATO allows you at the moment to write off that loss in your own name. It's called negative gearing, but essentially it is a tax loss. Now, we advise, and most tax accountants advise, that if an individual is going to buy a property in their own name and they're in a personal partnership, we would advise that that property is bought in the high income earner's name. The reason is because when that tax loss lodges in the individual's tax return, the expenses are more than the income, which means the higher the tax bracket of the individual, the better the cash outcome on their tax refund. So remember that one. The higher income earner in a personal partnership would always pick up the property in their name if it's negatively geared, if the expenses outweigh the revenue, as in a tax loss. The other tax loss that happens in a person's name is if they're running a small business. So we advise a lot of small business people when they kick off to start in their own names. It's very simple, cost effective, and they can get themselves started in the first year or two if they're kicking off a small business. Now, a business in your own name, a loss also goes on your individual tax return and can be claimed against other income in your personal return. However, there's one proviso here. The tax office many years ago, probably 10 or 15 years ago, required that the income of that business needed to be above $20,000. So, for example, if the business you're running is turning over $15,000 selling Amway products and your expenses are $25,000, creating that $10,000 tax loss, you're not allowed to write that loss off your personal tax return. So that's what the tax office did years ago. They knocked out called non-commercial tax losses. So tax losses in your own name, if you're running a business, your income of the business needs to be above $20,000. And then you can write off a tax loss in your own name. And it does happen. People start out in business, they might be turning over 60 to 70,000 in their own business, but they're getting up and going with all their marketing, setting up maybe a premises, all sorts of things where the expenses may be 100,000 and the income 60 in the first year or the first couple of years. And the tax loss can be written off in their own name. Tax losses, very important to understand. That's how they sit in an individual's name. Very, very valuable. See you soon.